For decades, a simple house key represented the single most predictable path to wealth in the American economy. The model was straightforward. You bought a standard suburban home, found a reliable tenant, and allowed the slow, natural appreciation of the market to build your equity over 20 years. But by 2026, the variables in that equation have shifted. Persistent high mortgage rates, combined with property prices that have decoupled from local wages, mean that the entry costs for a standard rental now exceed the potential returns for most retail investors. This chart shows the divergence. As traditional affordability collapsed, remaining market yields moved into alternative assets, prioritizing immediate cash flow. This fragmentation forced capital out of the cul-de-sac and into specialized niches like short-term rentals, mini warehouses, and industrial storage. Because the math no longer supports the passive model of the past, the era of effortless single-family appreciation is effectively over. This shift has created a boom in viral strategies, promises that by using AI, managing co-living spaces, or buying fractional shares, you can bypass the mansion and still build a portfolio. These methods are often marketed as universal hacks, but they are actually a series of rigid trade-offs that favor different types of resources. To evaluate these trends correctly, we have to look at this framework. Every modern investment choice starts with a single split in the road. If you choose to avoid the high down payments required by traditional banks, the market requires payment in another form. You are either providing intense, hyperactive physical labor, or you are giving up your ability to control the asset. This is the balance between capital barriers, how much money you need to start, and operational friction, how much of your daily life you have to sacrifice to keep the investment alive. Success depends on choosing a strategy that aligns with your specific constraints, rather than simply chasing the highest advertised return. Consider co-living. This strategy involves taking a single-family home and leasing it out room by room to individual tenants, rather than a single family. The gross revenue is the primary draw. A house that normally rents for $2,500 can often generate $5,000 or more per month when managed as a collection of individual units for students or remote workers. While those numbers look strong, this scorecard reveals the operational burden. Managing 6 unrelated strangers under one roof functions as an amateur hospitality business. You are dealing with exponential tenant conflict, higher wear and tear on the property, and constant turnover. The effort required to maintain the household transforms the investment into a grueling daily job. There is also the legal reality to consider. Many local governments view these properties as unlicensed dormitories, which can lead to zoning violations and immediate shutdowns. Ultimately, co-living converts your free time into a second, high-stress salary. In the short-term rental market, the 2026 landscape has become equally demanding. Generic properties no longer attract enough bookings to cover their costs. To compete, investors are building experiential properties, luxury tiny homes and themed retreats designed specifically for social media and cinematic appeal. These highly aesthetic designs command premium nightly rates and secure high occupancy, even in crowded tourist zones. However, creating these environments requires significant upfront capital. High-end furnishings, professional design, and unique architecture often double the initial investment required for a standard rental. There is also a regulatory vulnerability. A single change in local short-term rental laws can render these high-capital investments illegal overnight. To stay ahead, top-tier investors now rely on AI to analyze market data, predicting demand and pricing with mathematical precision. This tracking allows for better targeting, but it requires expensive recurring software fees. Since these data tools are available to everyone, the competitive advantage is short-lived. Your neighbors are likely looking at the exact same heat maps and pricing suggestions. Succeeding here requires outspending the market on both design and data, leaving very thin margins for error. For those who want to avoid property management entirely, the rise of digital fractional ownership provides a different path. These platforms allow you to pool money with thousands of others to buy small shares in large commercial or residential projects. This matrix shows the low capital barrier. You can enter the market with a small amount of money and face zero maintenance responsibilities. By surrendering all autonomy, you lose the ability to decide when the property is sold or how it is managed. Additionally, management fees and platform costs eat into the final yield, often leaving you with a significantly smaller return than if you own the asset directly. These shares are also illiquid. If you need your cash for an emergency, you may find it difficult to sell your portion of the property quickly. Fractional investing solves the problem of high entry costs, but it requires you to accept lower yields and a total lack of operational control. A final trend involves moving away from residential housing altogether and focusing on logistics real estate. This includes mini warehouses, commercial storage units, and fulfillment centers. The growth of e-commerce ensures steady demand for these spaces from both businesses and consumers. Unlike residential tenants, storage units require almost no daily oversight. There are no residents to manage. The structures are extremely durable, with low maintenance costs. The barrier here is the lack of emotional appeal and the complexity of commercial lending. Direct ownership usually requires a deeper understanding of business-to-business contracts and higher down payments. Logistics real estate provides a path to scalable cash flow for those willing to trade aesthetic appeal for operational stability. Choosing between these options requires a realistic look at your current resources. If you have more time than money, you are essentially trading your own labor for market access. This leads you toward co-living and arbitrage. You are taking on a management role to build your initial capital, and your success depends on your ability to handle high-friction daily operations. If you have capital but need to protect your time, the passive path is the only sustainable choice. This leads toward fractional shares and logistics-focused REITs. You should focus on avoiding the stress of property management, even if it means accepting a lower total percentage in returns. Finally, those with both significant cash and a willingness to work can find higher margins in premium short-term rentals. Every path works as long as it respects the reality of your bank account and your daily schedule. The modern real estate market does not offer magical, frictionless shortcuts. It offers a choice between different types of burdens. Ultimately, success in 2026 requires making deliberate and intentional choices about which risks you are equipped to manage. Many investors struggle, adopting a strategy without understanding the physical and mental effort it requires. Sustainable wealth is built by matching your investment choices to the actual requirements of your lifestyle. Stop searching for the perfect trend and start deciding which specific type of friction